Welcome. Today we're diving into the world of financial statements. Whether you're a business owner, a student, or just curious about how companies keep track of their money, understanding financial statements is essential. These documents are the backbone of any business's financial health, providing a clear picture of where money comes from, where it goes, and how much is left. In this video, we'll break down what financial statements are, why they matter, and how they're used in real life. Let's start by exploring the basics and setting the stage for a deeper understanding in the scenes ahead. Financial statements are formal records that summarize the financial activities and position of a business, individual, or other entity. They provide a standardized way to present financial information, making it easier for stakeholders to understand a company's performance. These statements are typically prepared at the end of an accounting period, such as a quarter or a year. They're not just numbers on a page, they tell the story of a business's financial journey, showing how money flows in and out. Next, we'll look at the main types of financial statements you'll encounter. There are three primary types of financial statements: the balance sheet, the income statement, and the cash flow statement. Each serves a unique purpose and provides different insights into a company's finances. The balance sheet shows what a company owns and owes at a specific point in time. The income statement reveals how much money was earned and spent over a period. The cash flow statement tracks the movement of cash in and out of the business. Together, these statements give a comprehensive view of financial health. Let's explore each one in detail, starting with the balance sheet. Balance sheet is often called a snapshot of a company's financial position at a specific moment. It lists assets, liabilities, and equity. Assets are what the company owns, like cash, inventory, and equipment. Liabilities are what the company owes, such as loans and accounts payable. Equity represents the owner's interest in the business after liabilities are subtracted from assets. The balance sheet follows the equation: assets equals liabilities plus equity. This statement helps stakeholders see if a company is financially stable and able to meet its obligations. Assets are resources owned by a business that have economic value. They can be current, like cash and accounts receivable, or non-current, such as property and equipment. Current assets are expected to be converted into cash within a year, while non-current assets provide value over a longer period. Understanding assets is crucial because they represent the resources a company can use to generate revenue and grow. Next, we'll look at the other side of the balance sheet: liabilities. Liabilities are obligations that a company must pay to others. They include loans, accounts payable, and other debts. Like assets, liabilities can be current or non-current. Current liabilities are due within a year, such as short-term loans or unpaid bills. Non-current liabilities are long-term debts like mortgages or bonds. Keeping track of liabilities helps businesses manage their cash flow and avoid financial trouble. Now let's move on to equity and see how it fits into the balance sheet equation. Equity represents the owner's share of the business after all liabilities are paid. It's sometimes called net assets or owner's equity. Equity can come from investments made by owners or from profits that are retained in the business. This section of the balance sheet shows how much value belongs to the owners. A strong equity position often means the business is financially healthy and has room to grow. Next, we'll shift our focus to the income statement, another key financial report. Income statement, also known as the profit and loss statement, shows a company's revenues and expenses over a specific period. It reveals whether the business made a profit or a loss. Revenues are the money earned from sales or services, while expenses are the costs of running the business. The difference between revenues and expenses is the net income or net loss. This statement helps stakeholders understand how well the company is performing and whether it's generating enough income to cover its costs. Revenue is the total amount of money a company earns from its normal business activities, such as selling products or providing services. It's the starting point of the income statement and reflects the company's ability to generate sales. Revenue can come from different sources, including product sales, service fees, interest, or royalties. Understanding where revenue comes from helps businesses identify their most profitable activities and areas for growth. Next, we'll look at expenses and how they impact profitability. Expenses are the costs incurred to generate revenue. They include things like salaries, rent, utilities, and materials. Expenses are usually categorized as either operating or non-operating. Operating expenses are related to the core business activities, while non-operating expenses are not directly tied to day-to-day operations. Keeping expenses under control is vital for profitability. By analyzing expenses, companies can find ways to cut costs and improve their bottom line. Now let's see how net income is calculated. Net income is the final result on the income statement. It's calculated by subtracting total expenses from total revenues. If revenues are higher than expenses, the company has a net profit. If expenses are higher, there's a net loss. Net income is a key indicator of a company's profitability and is often used to assess performance over time. Investors and managers pay close attention to this number when making decisions about the business. Next, we'll move on to the cash flow statement. Cash flow statement tracks the movement of cash in and out of a business during a specific period. It's divided into three sections: operating activities, investing activities, and financing activities. This statement helps stakeholders see how well a company manages its cash, which is crucial for paying bills, investing in growth, and staying solvent. Unlike the income statement, which includes non-cash items, the cash flow statement focuses only on actual cash transactions. Operating activities are the day-to-day actions that generate revenue, such as selling products and paying suppliers. This section of the cash flow statement shows how much cash is generated or used by the company's core business operations. Positive cash flow from operating activities is a good sign, indicating that the business can sustain itself without relying on outside funding. Next, we'll explore investing activities and their impact on cash flow. Investing activities involve buying or selling long-term assets, such as property, equipment, or investments. This section of the cash flow statement shows how much cash is used for investments that will benefit the business in the future. For example, purchasing new machinery or selling old equipment would be recorded here. Investing activities can result in either cash inflows or outflows, depending on whether assets are bought or sold. Now, let's look at financing activity. Financing activities relate to how a business raises and repays capital. This includes issuing shares, borrowing money, or repaying loans. The financing section of the cash flow statement shows the cash impact of these activities. For example, if a company takes out a loan, it receives cash, which is an inflow. When it repays the loan, that's an outflow. Understanding financing activities helps stakeholders see how a company funds its operations and growth. Financial statements are essential tools for decision-making. They help business owners, investors, lenders, and regulators assess a company's financial health and performance. By analyzing these statements, stakeholders can identify trends, spot potential problems, and make informed choices about the future. Accurate financial statements also build trust and transparency, which are vital for long-term success. Next, we'll discuss who uses financial statements and for what purposes. Many different groups rely on financial statements. Business owners and managers use them to guide operations and plan for growth. Investors look at financial statements to decide whether to buy, hold, or sell shares. Lenders review them before approving loans. Regulators and tax authorities use financial statements to ensure compliance with laws and regulations. Each group focuses on different aspects, but all depend on accurate and timely information. Let's look at how investors use financial statements in more detail. Investors use financial statements to evaluate a company's profitability, growth potential, and risk. They analyze trends in revenue, expenses, and profits to make informed investment decisions. By comparing financial statements from different periods or companies, investors can spot opportunities and avoid risks. Reliable financial information is crucial for building confidence in the market. Next, we'll see how lenders use financial statements to assess creditworthiness. Lenders, such as banks, use financial statements to determine whether a business can repay its debts. They look at cash flow, assets, and liabilities to assess the company's financial stability. A strong balance sheet and consistent cash flow increase the chances of getting a loan. Lenders also use financial ratios like the debt-equity ratio to evaluate risk. Accurate financial statements help businesses secure financing and manage relationships with lenders. Now let's explore how managers use these reports. Managers rely on financial statements to make day-to-day and strategic decisions. They use these reports to monitor performance, control costs, and plan for the future. By analyzing trends in sales, expenses, and profits, managers can identify areas for improvement and set realistic goals. Financial statements also help managers allocate resources effectively and measure progress toward objectives. Next, we'll discuss the role of regulators and tax authority. Regulators and tax authorities use financial statements to ensure that businesses comply with laws and regulations. They review these documents to verify that companies are paying the correct amount of taxes and following accounting standards. Accurate financial statements help prevent fraud and protect the interests of stakeholders. Compliance with regulations also enhances a company's reputation and reduces the risk of legal issues. Now, let's look at the basic principles behind preparing financial statements. Financial statements are prepared according to established accounting principles and standards. These rules ensure consistency, reliability, and comparability across different companies and time periods. Common principles include the accrual basis of accounting, the matching principle, and the going concern assumption. Following these principles helps ensure that financial statements present a true and fair view of a company's financial position. Next, we'll discuss the importance of accuracy and transparency in financial reporting. Accuracy and transparency are critical when preparing financial statements. Mistakes or intentional misstatements can mislead stakeholders and damage trust. Transparent reporting means providing clear, honest, and complete information about a company's finances. This builds confidence among investors, lenders, and regulators. Companies often have their financial statements audited by independent professionals to ensure accuracy. Now, let's look at the process of preparing financial statements. The process of preparing financial statements begins with recording daily transactions in the accounting system. These transactions are then summarized and classified into accounts. At the end of the period, accountants adjust the accounts to reflect any changes or corrections. Finally, the financial statements are prepared and reviewed for accuracy. This process ensures that the information presented is complete and reliable. Next, we'll discuss the role of technology in financial reporting. Technology has transformed the way financial statements are prepared and analyzed. Accounting software automates many tasks, reducing errors and saving time. Cloud-based systems allow for real-time access to financial data from anywhere. Data analytics tools help businesses gain deeper insights into their finances. Technology also makes it easier to share financial information with stakeholders. Now, let's look at some common challenges in financial reporting. Despite advances in technology, businesses still face challenges when preparing financial statements. These include complex accounting rules, data entry errors, and the need for timely information. Small businesses may lack the resources or expertise to prepare accurate reports. Regulatory changes can also create confusion. Overcoming these challenges requires ongoing training, strong internal controls, and regular reviews. Next, we'll discuss the importance of internal controls in financial reporting. Internal controls are policies and procedures designed to ensure the accuracy and reliability of financial statements. They help prevent errors and fraud by establishing checks and balances within the accounting process. Examples include segregation of duties, regular reconciliations, and approval requirements for transactions. Strong internal controls are essential for producing trustworthy financial reports. Now, let's explore the role of audits in financial reporting. Audits are independent examinations of a company's financial statements. Auditors review the company's records, test transactions, and assess internal controls. The goal is to provide assurance that the financial statements are free from material misstatements. Audited financial statements give stakeholders greater confidence in the accuracy and reliability of the information. Next, we'll discuss the limitations of financial statement. Financial statements are valuable tools. They have limitations. They provide a historical view and may not reflect current market conditions or future prospects. Some assets and liabilities may be difficult to measure accurately. Financial statements also rely on estimates and judgments, which can introduce bias. It's important to use financial statements alongside other information when making decisions. Now, let's look at how to analyze financial statements effectively. Analyzing financial statements involves reviewing key figures, ratios, and trends to assess a company's performance. Common techniques include ratio analysis, trend analysis, and benchmarking against industry peers. By digging deeper into the numbers, stakeholders can identify strengths, weaknesses, and opportunities for improvement. Effective analysis requires both quantitative skills and an understanding of the business context. Next, we'll discuss some important financial ratios. Financial ratios are tools used to evaluate different aspects of a company's performance. Common ratios include the current ratio, debt-to-equity ratio, and return on equity. The current ratio measures liquidity, showing whether a company can meet its short-term obligations. The debt-to-equity ratio assesses financial leverage, while return on equity measures profitability. Understanding these ratios helps stakeholders make better decisions. Now, let's see how financial statements are used in practice. Practice, financial statements are used for budgeting, forecasting, and evaluating performance. Businesses rely on these reports to set financial targets, monitor progress, and make adjustments as needed. Financial statements also play a key role in securing financing, negotiating contracts, and planning for expansion. By using financial statements effectively, companies can achieve their goals and stay competitive. Next, we'll look at how financial statements support decision-making. Financial statements provide the information needed to make informed business decisions. Whether it's launching a new product, expanding into new markets, or cutting costs, these reports offer valuable insights. Decision-makers use financial data to weigh risks and rewards, allocate resources, and measure success. Accurate and timely financial statements are essential for effective decision-making at every level of the organization. Now, let's discuss the importance of regular financial reporting. Regular financial reporting keeps stakeholders informed and helps businesses stay on track. Monthly, quarterly, and annual reports provide updates on financial performance and highlight any issues that need attention. Consistent reporting also makes it easier to spot trends and respond quickly to changes in the business environment. Regular financial statements are a key part of good corporate governance and accountability. Next, we'll look at the role of notes to the financial statement. Notes to the financial statements provide additional details and explanations about the numbers in the main reports. They include information about accounting policies, assumptions, and any unusual transactions. These notes help users understand the context behind the figures and make more informed decisions. Notes are an important part of transparent financial reporting. Now, let's discuss the difference between audited and unaudited financial statement. Audited financial statements have been reviewed by independent auditors, who provide an opinion on their accuracy. Unaudited statements are prepared by the company without external verification. Audited statements offer greater assurance to stakeholders, while unaudited statements may be used for internal purposes or interim reporting. Understanding the difference helps users assess the reliability of the information. Next, we'll look at the impact of international accounting standards. Many countries follow international accounting standards, such as the International Financial Reporting Standards, IFRS. These standards promote consistency and comparability across borders, making it easier for investors and companies to operate globally. Adopting international standards can also improve transparency and attract foreign investment. Now, let's discuss the role of ethics in financial reporting. Ethical behavior is essential in financial reporting. Companies must present their financial information honestly and avoid misleading stakeholders. Unethical practices such as manipulating numbers or hiding debts can lead to serious consequences, including legal penalties and loss of reputation. Upholding high ethical standards builds trust and supports long-term success. Next, we'll look at the future of financial statements in a digital world. The future of financial statements is increasingly digital. Advances in technology are making it easier to prepare, analyze, and share financial information. Digital reporting platforms offer real-time updates, interactive dashboards, and enhanced security. As technology evolves, financial statements will become even more accessible and useful for decision-making. Now, let's summarize what we've learned about financial statements. Sum up: financial statements are essential tools for understanding and managing a business's finances. They include the balance sheet, income statement, and cash flow statement, each providing unique insights. Accurate, timely, and transparent financial reporting supports better decision-making and builds trust with stakeholders. By mastering financial statements, you can gain a clearer picture of any organization's financial health. Next, we'll provide some tips for reading financial statements effectively. In reading financial statements, start by reviewing the main reports and then dive into the notes for more details. Look for trends over time, compare figures to industry benchmarks, and pay attention to key ratios. Don't rely on a single number, consider the bigger picture. If you're unsure about something, seek clarification from a financial professional. With practice, you'll become more confident in interpreting financial information. Now, let's look at some common mistakes to avoid. Common mistakes when using financial statements include focusing only on profits, ignoring cash flow, and overlooking notes or disclosures. It's also important not to compare companies without considering differences in size, industry, or accounting methods. Avoid making decisions based on incomplete or outdated information. By being aware of these pitfalls, you can use financial statements more effectively and make better decisions. Next, we'll discuss the importance of continuous learning in finance. Finance is a constantly evolving field, with new rules, technologies, and best practices emerging all the time. Staying up to date with changes in accounting standards and financial reporting is essential for anyone who works with financial statements. Continuous learning helps you stay competitive and make better decisions. There are many resources available, including courses, books, and online materials. Now, let's wrap up with some final thoughts on the importance of financial statement. Financial statements are more than just numbers. They're powerful tools for understanding, managing, and growing a business. By learning how to read and use these reports, you can make smarter decisions and contribute to your organization's success. Whether you're an investor, manager, or student, mastering financial statements is a valuable skill. Thank you for joining us on this journey through the basics of financial statements. We hope you feel more confident and informed about this important topic. Now that you have a solid understanding of financial statements, consider exploring more advanced topics like financial analysis, budgeting, or investment strategies. The world of finance is vast and full of opportunities to learn and grow. Remember, the more you practice reading and interpreting financial statements, the more skilled you'll become. Keep building your knowledge and applying what you've learned to real-world situations. Good luck on your financial journey.